Hi everyone, myself Murugan. Happy to present another interesting video from Axis. In this video, you will be learning all about dividends. If you are constructing a portfolio from a very longer term perspective, you may really look for a passive returns along with capital growth. Then you must be investing in shares. And here, dividend is not mandatorily need to be paid by company, but a dividend paying company got its own stories to convey. So as an investor, you need to know a bit more about the terms relevant to dividend, and you need to know about the stock selection criteria. So this video explains things in two parts. The first part talks about the key terms and its concepts, and the second part talks about the stock selection criteria. So let's get in detail of it. What is dividend? Dividend is after all the reward to the shareholder. Let's say if you have a land, you naturally expect rent for the land for the holding period. The day you sell the land, you look for a reasonable capital appreciation which justifies the investment you made at the very first day when you bought the land. Let's say you are a lender. When you lend your money, you naturally expect the money to be paid back and along with some reasonable interest for the holding period. Likewise, when you wish to give your money to the company who wants your money to run their show, then you naturally expect the portion of profit to be distributed to you. That is what we generally call that as a dividend. So the dividend is distributed out of the company's profit. That is the most common way. But sometimes some portion of profits was not distributed, rather it is kept in form of reserves and getting accumulated over a period of time, and such accumulated reserves one point of time getting distributed to the shareholders, that out of reserves, if it is getting accumulated and getting distributed to the shareholders, that can also be another way of doing. So most of the time, the company issues their dividend out of their net profits. Sometimes the retained profits, maybe reserves and surplus, can also be compounded at one point of time, enables the company to offer the dividend. But there are three ways by which a company offers the dividend. Number one, which is a very popular, generally most of you can easily understand, that is a cash dividend. Let's say a company makes 100 rupees of profit, out of which 60 rupees they don't need this money anymore. So they decided that 60 rupees to be divided by number of shares, and then it will be given back to all the shareholders. Let's say the company is owned by hundreds of shares, then 60 will be divided by 100. In that case, 60 paise for every shares. And if you own 10 shares, you will get close to 6 rupees. That's how the company's profits getting splitted by the shares and given to all the shareholders. I hope you got this. Is pretty straightforward and easy to understand. But sometimes what happens is a company makes about 100 rupees of profit, out of which a company don't need, let's say, about 20 rupees, and the 20 rupees can be splitted by 100 and given to the needy people. Not the needy people, all the shareholders. But sometime company goes for buyback. I mean, company says we got 20 rupees. If anybody is interested to surrender their shares, kindly come and give your shares. We are ready to buy back. We are okay to pay you 1 rupee per share. And if anybody is interested to surrender the shares, that's a kind of buyback. So in this case also, company is going to give this 20 rupees to the shareholders, but not to all the shareholders, but only those who are ready to surrender the shareholders. So it is depends upon what is good for the company and depends upon the market scenario. Company can opt in, and of course, with the approval of shareholders, these decisions are taken. So in cash dividend or buyback, the real cash is going out of the company and shareholders are getting it. But remember, if a company wants to reinvest that money, so what happens is whatever the profit made, let's say a company made a profit of 20 rupees last year, and next year 20 rupees, another year 20 rupees, another year 20 rupees. Likewise, a consistent 5 years of profits were retained and it is called as reserves and surplus. Ideally, this money can be given back to shareholders. So a company got 100 rupees, can be divided by 100, and each and everyone can get one. But sometimes what company does is company may decide not to give this 100 rupees to the shareholders. Rather, what company decides is we're gonna print new shares and kind of 100 shares, and anybody who got one share will be getting one more share at free of cost. It's called bonus. But in all three cases, you would have seen that the retained profits or the profits are distributed to the shareholders. But in the third case, you have seen that this is distributed not in form of cash, but in form of the printed shares. I hope you got it. there are three ways by which a companies can distribute their profits to the shareholders. One is cash dividend, the other one is buyback of shares, the third one is stock dividend. Whereas in stock dividend, the real cash outflow has not happened, whereas that entire money is being reinvested into the company. But in this particular video, we're gonna see something in detail, which is cash dividend. Let's first get in to see those terminologies relevant to the cash detail. The very first one is dividend percentage versus dividend yield. Let's say I assume that you are kind of fresher to the stock market, or you are just getting started with your investing journey. You get sometimes surprised to see that the dividend percentage comes out with 100%, 200%, 500%, 1000%, 1500%. These percentage actually can mislead you, because the dividend percentage by the beginner or the novice generally considered along with the share price. That shouldn't be seen in that way, because the dividend percentage are benchmarked with the face value of the share, not with the current trading share prices. Kindly understand. I'll show you a quick difference. Let me actually go and take this Google, so that become much easier for you to understand. If I hit a Google and if I search, I'll take a company called TCS. Okay, if I take TCS dividend, then I'm getting in detail through the very first link offered by Google. So if I go to this, I'm getting it. Okay, now try to understand this factor, which is the dividend summary, which belongs to Tata Consultancy Services, a listed company in India, which is NSE. And you see that the dividend percentage is 700% offered on 31/12/2021. The month of September, they offered 30. The month of June, they offered close to 700%, 1500%, 1500%, 600%. Okay, now the share price of Tata Consultancy Services is close to 3,661. This 700 doesn't mean it is close to 24,000 rupees dividend. This percentage is after all benchmarked with their face value. This is after all benchmarked the face value. If you want to know what is face value, then what I can do is take them through the financials. And if you scroll down, you see where is the face value here. The face value is after all 1. And if you look at the dividend, what they offered is 700. It means the company actual dividend is only 7 rupees. The company actual dividend is only 7 rupees. So if you consider this 7 rupees, the 7 rupees, how I got the 7 rupees is 1 multiplied by 700%. This is pretty straightforward. That's how they got a dividend. So in general, in most of the places, you will come across with something called 700%, 600%. This is something which is referring the face value. What is face value? Face value is maybe that the original share price, if you are there at the promoter level, okay, but not even at the IPO date. So these days, the shares are even getting issued at premium. So face value and the share prices are different. The rate at which you buy the shares are the face value or the share prices. Okay, the face value is slightly immaterial for you, because you are not going to acquire the shares based on face value. So I hope you got the first point, which is very clear. So don't get misled with the term called dividend percentage. Then what do you mean by yield, Murugan? The term yield talks about the dividend for the given share price, not based on face value. Let's say the share price is 1,000, and if the dividend is 7 rupees, the dividend is actually 7 rupees, then the dividend yield close to 0.7%, even 7%. Am I right? 70 rupees is what, 7%. So if it is if it is 7 rupees alone, then it is. And of course, what you saw in the TCS in this case is all the dividend for the quarter. So for the year, they would have given a dividend close to 2.1%, or in some cases they would have given a dividend close to 4-5%. That's a different story here. So I hope you got that the first point, dividend percentage and dividend yield. Okay? So this is how we get to know how much dividend one can expect on hand. So if I buy shares worth rupees 3,000, and if I get a dividend, let's say about 30 rupees, then I get to know that the kind of dividend what I get is close to 1%. Okay? Although the company says that we have given 3,000% dividend, the 3,000% dividend is based on the face value of 1. Doesn't mean that the share price of 3,000. So I hope you got it. The second one is dividend payout ratio. Dividend payout ratio, remember, We will be having a very interesting quiz towards the end of the video. And to answer those quiz, you have to understand these terms. And if you understand these terms, it becomes much easier for you to select a stock. And as we get in detail, it becomes much more relevant. So pay attention to the dividend payout ratio. The dividend payout ratio is very important, which is a very interesting factor by which you can have a predictability of the company paying dividend. Because let's get in detail of this. Again, I go to very interesting website called Screener. Okay, now if I go to a screener.in, if I go to a website called Screener, if I type in company called TCS, and look at this, the company made a profit. Okay, the company kind of making a net profit after taxes 9,000 crores, 10,000 crores, 13,000 crores, 19,000 crores, 19,000 crores, 25,000 crores. So you see, on year, the company is actually increasing their net profits, and the company, in the recent term, the profit is close to 38,000 crores. Company made 38,000 crores as a net profit. That's very interesting, right? So out of 38,000 crores, they paid 41% as a dividend. Okay, the dividend payout is close to 41%. So close to 40% they paid as a dividend. So by referring this percentage over a period of time, you get a predictability that how much a dividend I can expect going forward. And dividend payout ratio is not the only factor, but you can consider few more things also to have the predictability. But dividend payout ratio is one of the interesting factor which helps you to understand the company consistency in paying out their profits and dividends. So you get to know that how much dividend you can expect based on the profits they made out of the company. So that's the second factor. And the other one is dividend declaration date. The dividend declaration date is also interesting because dividend declaration date is not the date you get a dividend, and dividend declaration date is not the date is considered to count the shareholder's name. Okay, dividend declaration date is just the date got announced through the general meeting or through maybe an interim meetings. So let's say I'll take another example to show you. If you look at the Tata Consultancy Services, the announcement date of the dividend is 31/12/2021. The X date is 19/01/2022. Okay, now try to understand these two different dates. Announcement date is the date the board would have got a meeting, maybe a board meeting would have happened, and the board might have proposed it, and the shareholders would have approved it, and then it got into the the reality that the company is going to announce. But they will come up with one interesting date called X date. Let's say in this case 19/01/2022. So on or before let's say by 18th January 2022, even if you buy shares, you will be considered for a dividend, provided you didn't sell the shares till 19/1/2022. But remember one thing, on 19th it has become X date. I mean, by 19th, if you buy shares, you will not be eligible for the dividend. So either you buy it on 18th or 17th or 16th or 15th, you are eligible for the dividend. But if you buy shares on 19th, you are not eligible for the dividend. Because by 19th, if shares are there in your account, only then you are eligible. But 19th morning, if you buy shares, you are not eligible for the dividend. 18th, if you bought the shares, you somehow get reflected in the dividend story, and you will get the dividend. So that's how the X date is counted. I hope you got some clarity. If you need any more questions related to X dates and come dates, put it in the comment section. Hope you will get it resolved. So that's how the two important dates. One is dividend declaration date is just the announcement got out. Okay, and that was got confirmed. But the X date is the date that the list of shareholders holding the shares will be, get to know that they will be eligible for the dividends. Dividend payment date may be a different dates. Okay, the company make a payment in about next 10 days or 15 days. You will get dividends in your account in form of cash. Remember, if shares are in your demat account, you will get the money in your the bank account which is linked to your demat account. In case if shares are there in the your broker account, then your broker will pass on to your the broker ledger account. So that's how the shares get distributed. So by any chance, if you don't get the dividends, make sure that although you have shares on X date, you check out your broker. Broker can make you to understand how it is. So, but everybody on the X date holding a shares are eligible for the dividends. So but the dividends are reflected in your account on the dividend payment dates. So that's how the dividend payment dates. So these are all the three important dates you need to know, and the payment ratios helps you to have the predictability, and the percentage and yield is also important. So I hope you got these key terms clear about it. So let me talk about the profit versus cash profits, because remember, not all profits can be considered for the dividend. Let's say a company made 10,000 crores profit. A company cannot give entire 10,000 crores as a cash, as a dividend, because out of 10,000 crores, some portion may be unrealized, may be realized by the next year. So what is a very important factor is the cash flow in the company, not the mere profits. So if you are planning to invest in a dividend paying company, make sure that the company is having a cash rich company. Only then they have eligibility to pay the dividends. But and one more interesting thing, although the lot of cash is being generated, but sometimes those cash are reinvestable. Okay, so make sure there is a cash profit versus distributable. So if portion of capital is needed for reinvestment, then that is not distributable, am I right? So if a company having a less capital expenditure requirement, then only the company can actually pay that cash to the shareholders. If not, it has to be reinvested. So if you're planning to invest in a company which can potentially give you money back in form of dividend, then you need to have these two factors. The first factor is the company making cash, and is these cash are needed by the company or not. These are the two factors which you have to consider to pick up. And the very other interesting aspect is it mandatory for the companies to pay dividend? Definitely not. As per SEBI or even most of the regulators in the world doesn't force the company to pay the dividends, because the dividends, the management is a better person to, the board has to decide whether the money to be reinvested or not. But a matured companies, a top companies generally makes it predictable for the shareholders through their dividend distribution policies. So what you guys can actually do is, if you really want to know about the dividend distribution policies, what you guys can actually do is you can actually go to this, like you can hit Asian Paints. Okay, Asian Paints distribution policy. Okay, dividend distribution policy. If you hit it, so you will have kind of policies coming up like this. So dividend distribution policies, make sure that it is authenticated from the company website itself or from the exchange's website. Okay, and then you will have their policies very clear on what grounds these companies offer their dividends. Okay, so they will say that it depends upon various reasons. Maybe the company should have a, if a company need the future growth, if a company finds some opportunities, the company needs optimal free cash flows to fund. So if there is no legal requirement or anything, otherwise they'll give dividends. They will make it pretty much clear through their policy that how frequent, they will provide dividends and everything. So you can also look for a dividend, a TCS uh, distribution dividend distribution policy here, and you can also find it here. So what you guys can is, like, you can see this is how their dividend distribution policy. So they consider these factors to issue dividend: net profit generated, cash balance, and cash flows. And if they have any business plans and other thing, of course, their most recent dividend distribution policies made it very clear that on every quarter they pay dividend and everything. Of course, I think this got released at 2017-18. What you guys can do is, we will be having some quiz, no? We will be asking some questions. So we will give you some company choice on which you have to answer. So that will make you to browse these things, and that justifies of you watching this video as well. So I hope, let's see how interesting it becomes. So if a company pays dividend, does the shareholders' wealth really get maximized or not? That depends on various factors. So pay it very closely. The dividend maximizing the shareholders' wealth really depends upon the company's reinvesting ability. Pay attention. Let's look at the first one. If a company got a very high market share, okay, company got a very high market share, but the industry, the industry at which a company operate got a very low growth rate. Okay, the kind of industry which the company operate is very matured industry, maybe commodity style industry, which depends on a lot of factors for the growth, but the company is a leader in that industry. Okay, and such companies pays dividend is very good, because you are a very big company, but the whatever you do is not required for reinvesting because the industry itself not growing in a very massive scale. So their reinvestment is actually needless in this case. It is better for the company pays the dividend back to the shareholders. It's a kind of cash cow sort of a business. Look at this one, which is a high market share. A company may be a very big company, but high industry growth. In this case, if a company pays, if a company pays the portion of profits to the shareholders, I don't say it is a bad. And even if they reinvest in the business, that is also not bad. So it become irrelevant. Either company pays dividend or doesn't pay the dividend, your wealth gets maximized. Okay. If you are getting it, so you may get a cash today, your share growth accordingly gets limited. If they don't give you, rather if they're reinvesting and if the company has a high market share and growth rate is also good, industry growth rate is also good, doesn't mean you got money back from the cash, but still your growth will be good. So the second factor is a classic, but it doesn't really depend upon the dividend. So evergreen, such companies will eventually add wealth to you. But the third factor is very important, which is a company got a very low market share, but the industry growth rate is very high. Remember, the industry growth rate is very high, but the company may be at a growing stage. I mean, growing stages, a company got a low market share and a good growth rate, and industry growth rate is also very good. Such companies can retain the profits and reinvesting the profits and getting a good return on capital employed is all important. If it is all there, such companies, even if they don't pay dividend, it is a good factor. I hope you understand which company should pay dividend, which company should not pay dividend. So if you have a company, ideally good to pay dividend. If not paying a dividend, then you should consider seriously. And if there are companies like this third one, low market share, high industry growth, maybe a mid cap companies. Okay, it's not may not be a large cap company. A low and a high industry growth, then they don't have to pay dividend and make sure that their return on capital employed is getting higher over a period. That's very important. Okay, why long term portfolio considers a dividend paying company? Because in a very longer term, when I'm constructing a portfolio, after 10th year, if a company, if a company build a very good wealth, and this dividend paying companies offers me a very passive income, so it doesn't make me to dilute my stake. Rather, I can sit holding on to my shares, and I still get some money for my expenses or my objectives to be. So if I want to have a perpetual holding on my shares, and if I still want some returns, it can be achieved only if I have some companies offering me a reasonable dividend. So passive income, along with perpetual holding, can be achieved provided the company offers me dividend. Number two, high dividend paying companies shows the sign of maturity they have. If a company is showing paying a dividend, not just about surprisingly 1 year, I'm talking about the dividend paying companies with a consistency of last 5 years and 10 years, then it actually tells me that the consistency of paying dividend, and that's a sign of a matured company. And these companies behaves as defensive during the market corrections. So whenever there is a short term corrections, these companies make sure that my portfolio drawdown is not high. So it's some way that dividend paying company adds value to the shareholders. May not be directly monetary, but indirect monetary adds significant values. So by what means I can find such companies, Murugan? Let's say I'm constructing my portfolio from a very longer term. How do I construct a portfolio using this? Number one, as I shown you some time back, you have to hit the company, search for dividend distribution policies, and then I hope you will get there, a clarity. Some companies makes a statement like we minimum give 30% dividend of their profits. A lot of government companies, because the government companies forces the government companies to pay the dividend because the government depends upon that money for their fiscal policies. So in lot of public sector companies, you see a very structural, consistent dividend paying factors. So you get to know by reading their dividend distribution policies. Okay, likewise, we gonna give you a quiz now, and we give you 4 choices, and out of which one company is actually paying dividend distribution policy itself says that the company will pay close to 80% of the profit will be distributed as a dividend. You have to guess the company. So I'll tell you where you can find those quiz link. Maybe available in the descriptions, and you can find the quiz. And of course, there will be 5 questions, and answering the question, you will get a quick answer as well. The second question is the cash flow from the operation okay, the cash flow from the operation, and that cash flow's growth, okay, and consistently over a period of 10 years should be around 10% at least. And if company is consistently having a growth rate, a cash flow from the business, okay, they're not from financing, not from investing, the cash flows from the operations are growing at the rate of 10% for the period of 5, 8 or 10 years, that is the company become very matured of offering dividends, okay. And if the company got a low capex requirement, very possible they offer a dividends. And if you want to have a predictability, go and check the payout ratio. As I told you at the very beginning, that you can actually go and check out the, their distribution policies payout ratio. Look at the TPS. They're consistent about paying out close to 45%, and sometime, of course, once in 4 years they offer slightly more dividend, because anything surplus they got, they will actually pay as a dividend. So these are all the factors by which you get a clarity whether this company will pay dividend or not. And having seen these things, if you want to summarize it, the way by which you can summarize it is by answering the quiz. Because we're going to answer you straightforward 5 quiz questions. By answering those questions, you get to know how to make it actionable. Where do you find those quiz? So the quiz link will be in the description. The quiz link will be in the description. If not, you can find the quiz again. You can actually go to our website. There also you can find it, the quiz link under the quiz section. But otherwise, in the same video description also you can find the quiz link. Okay. So hope I hope you can hit on the quiz, and you will be taking up this quiz there, and you will get a quiz result also instant. There will be 5 questions asking about a bit of payout ratios, bit of dividend distribution policy, bit of companies you can pick up. So that's a good thing. And if you wish to share any stocks having a very a good track record of growth rate along with dividend, okay, both. If you have such things, and if you want to add any more points relevant to dividend points, put it in the comment section, because it helps us to, and it motivates us to work on it. And if you wish to learn more about this through fundamental, we have a training program which talks about it, and you can definitely practice along with this. So if you want to know more about it, then what I can do is just go to Google and hit equisys.com, and you see something called training. Underneath training, you have advanced level training programs, and of course, you see a fundamental analysis where you can learn a lot of concepts which are good for a long term investment. So I hope this can also help you. And the last interesting factor is, if you want to construct a portfolio by which you want to invest from a very longer term perspective, then you can definitely consider something called Axis Invest, because Axis Invest is a very simple platform, gives you a list of shares you can buy every week or every month, not for a short term returns, like constructing a portfolio for like SIP directly into the shares. But Murugan, who will be reminding me what stocks I will be buying, how frequently I will be buying shares, and how do I churn my portfolios? Who will be reviewing my portfolios? Everything will be taken care by us, but you will be reminded accordingly, wisely, with a very nominal fees. You can definitely try that. So if you still want to know what is it, like what you guys can do is hit on investing here. So hit on investing here, and it will take you through that particular portal. Of course, with a very nominal cost. If you wish to invest, let's say every month you wish to invest about 25,000 rupees, and if you click start, and of course it takes you through the plan of 25,000, of course very nominal. If you want a coupon, if you want a coupon, I can definitely recommend a coupon. Will be available in the description. Check out the description, probably give you a 10 or 20% discount. So and maybe last for 2 or 3 days when I promote this video. And if you want, if you see this video a bit late, make sure that you subscribe and hit the bell button, so that you will get upcoming videos along with some coupons, maybe benefit you. Okay, so that's how you can get it some fair discounts from us. So these are all the ways by which Axis continue to provide support. So I hope you find this video interesting and useful. Thanks for watching this video till this minute.